Think bonds are just for retirees? Think again. Here's how young investors are crushing it with bonds. Today we're diving into the world of bond investing for younger investors. But if you're an older investor but young at heart, you should stick around too, because I've got an interesting market timing strategy that can be fun for you too. Whether you're a complete newbie or you've dipped your toes in the stock market, bonds might be the missing piece of your financial puzzle. So why should you, a young, vibrant investor, care about bonds? Well, let me paint you a picture. Imagine you're building a house. Stocks are like the flashy paint job and the cool furniture. They can look great and increase the value quickly, but they are also the first things to show wear and tear when times get tough. Bonds, they're your foundation and framework. Not as exciting maybe, but boy, do they keep things stable when storms hit. Raise your hand if you'd buy a house without a foundation and framework. Now let's talk about when to invest in bonds. The answer might surprise you. It's right now. But Michael, you might say, I'm young. Shouldn't I be going all in on stocks? You should absolutely have the bulk of your investments in stocks. And if someone tells you otherwise, you should seek out a new YouTube channel. Preferably this one. However, while it's true that stocks often offer higher returns, bonds offer something equally valuable: stability and certainty. And like it or not, sometimes those are more important. Here's where the magic happens. When you hold individual bonds through a recession, something amazing occurs. While stock prices might be doing the electric slide, and not in a good way, your bonds keep plugging along, paying you interest like clockwork. It's like having a steady paycheck in a world gone mad. Picture this, it's 2008, the height of the financial crisis. The stock market is crashing harder than a dad at a Taylor Swift concert. Investors are panicking, selling everything in sight. But amidst the chaos, a group of savvy bond investors are sitting pretty. You see, years earlier, they had invested in high-quality corporate and municipal bonds. While their stock-heavy friends were losing sleep and a lot of money, these bond pros were still receiving their interest payments like clockwork. Their portfolios remained stable, and some even saw the value of their bonds increase as interest rates dropped. The lesson? In times of crisis, bonds can be your financial superhero. Now let's dig into how younger investors can actually use bonds. Different financial situations call for different strategies. First up, saving for a down payment. If you're aiming to buy a house in, say, 5 years, bonds can give you a reliable way to grow your money while avoiding the chaos of the stock market. Specifically, something like a 5-year Treasury bond, or a high-grade taxable muni zero-coupon bond that comes due in 5 years. These ensure you'll get your money back right when you need it, but it also means your money is still working for you. Wouldn't it be awful if the stock market took a dip and your index fund got clobbered just as you were out looking for your first home? It's just too important of a purchase to take that kind of risk with. Use bonds to get you where you want to be. 2. Got a child who may need help paying for school someday? Consider a combination of index funds and high-grade zero-coupon taxable municipals or corporate bonds. You don't want to risk losing all of your money in stocks right when you need that cash to pay for school. Bonds that come due around the time they'll start school will provide the needed cash should the stock market and those index funds be in a bit of a soft patch. What I did was I purchased index funds through a 529 plan and also bought high-grade taxable municipals in my children's education IRA. I bought them with maturities that came due right around the time they'd be starting school. That way, if the stock market was in a bad place, I didn't have to liquidate at the bottom because we'd have cash available from the maturing taxable municipals. It worked out as planned, and we had money available as they needed it, and we got all of the tax benefits of both 529 and education IRA. 3. Building an emergency fund? Let's talk about a crucial aspect of investing that often gets overlooked: your emergency fund. As a younger investor, you might be tempted to go all in on high-risk, high-reward investments. But here's a safe investing tip that could save you. Consider putting your emergency fund in a combination of a money market mutual fund and short-term bonds. Why? Money market mutual funds offer liquidity. You can withdraw your money at any time without penalty, and typically they offer a better return than a savings or checking account at your bank. Short-term bonds, on the other hand, can offer slightly higher yields while still maintaining relatively low risk and high liquidity. This combo gives you the best of both worlds. Easy access to your money when you need it, with the potential for better returns than a traditional savings account. Remember, your emergency fund should cover 3 to 6 months of living expenses. By investing it wisely, you're not just preparing for rainy days, you're making those rainy day funds work for you and making sure your cash is keeping up with inflation by investing it for safety and liquidity, while still getting a solid return on your money. If you're finding this information more exciting than watching paint dry, let's face it, in the world of finance, that's high praise. Go ahead and smash that like button. And if you want more bond wisdom delivered straight to your feed, subscribe faster than you could grab that last slice of pizza at a party. 4. If you're intrigued by the possibility of moving a little money into bonds, but are looking for potentially higher yields and don't mind a bit more risk, corporate bonds might be your jam. And for those of you who want to support your local community and potentially save on taxes, municipal bonds are worth a look. Just be certain you have a solid understanding of the ability of those entities to make timely interest and principal payments. Don't go chasing the bond with the highest yield. Typically, the higher the yield, the higher the likelihood the issuer will go into default. In other words, not pay you what they owe you. When I was in my 20s and 30s, I made sure the bonds I was buying were rated A1 or higher by Moody's and A+ or higher by S&P. If the ratings on those bonds I owned dipped below those levels, I replaced them with bonds with higher ratings. Better to take a little hit because the credit quality of your bond declined than to lose most of it because you hung on to it and the issuer went into default and you lost almost all of it. Now let's move on to number 5. Taking higher risks on bonds that will reward you big if interest rates go down. This is the last one and the most lucrative and most risky, so proceed with caution. Now here's a tip you can use if you want to take a bit more risk for potentially higher returns. U.S. Treasury strips. Strips are zero coupon bonds, meaning you buy them at a deep discount and get the full value at maturity. If you think interest rates are going lower, strips can be a huge win. The value of these bonds increases when rates drop, so they could give you a nice bump in your portfolio if you time it right. Treasury strips are the most advantageous place to invest when you think interest rates are going to decline. The strip market is incredibly large and liquid. They can be purchased through your investment advisor or a DIY platform like Fidelity or Schwab. Because they don't make regular interest payments, they have the highest duration of any Treasury security. This means they offer the most potential price appreciation when rates fall. But, like any risk-reward combination, they offer the greatest risk and potential for loss if interest rates rise instead. To maximize this strategy, you'll use the longest strip available, the 30-year strip. If you purchased it as of this recording, the 30-year strip, which would mature in February of 2054, that bond would cost you $300 per $1,000 of face value. This is a yield, if held to maturity, of 4.166%. If in 1 year the interest rate on that bond goes down by 100 basis points or 1% to 3.166%, the price would increase to $413 per $1,000 face value. That's an increase of 37.6%. That's a great return if you're right about where interest rates are headed. I went through some more scenarios like this one in the video on the screen now. You may want to check that one out. But let me step back for a second and give you a word of caution. This doesn't work with all bonds. The reason we picked Treasury strips is because they move typically along with the Treasury market. If you were to buy, say, a long taxable municipal or a long corporate zero coupon bond, they wouldn't necessarily respond as true to the declines in interest rates you may see across the board. They're going to be impacted by a lot of other factors. On the corporate side, you'll have issues that might be specific to your bonds sector or that bond's specific company if they run into challenges. On the municipal bond side, you're impacted by the supply and demand of the entire municipal market, as well as the stability of the municipality of the bond that you bought. There are a lot of other factors that can weigh in. That's why we use a Treasury strip, and specifically the strip because of the higher duration, but we stay closely tied to the Treasury market because it will move the truest with interest rates if you're expecting them to decline. Now let's address some common objections to bond investing. Some might say bonds are boring. So is a seatbelt until it saves your life. Here's the thing. I've mentioned this objection on this channel before, but let's get serious for a second. If you're investing for the thrill or the rush, you're doing it wrong. This is about your financial future. If you're looking for a thrill, walk into a casino and slap $100 on red and walk right back out no matter the outcome. Stop investing for the rush of endorphins. Sit down and think about where you want to be in the future and make a plan to get there. Even a conservative approach, like putting your money into an S&P index fund, still leaves you vulnerable and beholden to the market for important life decisions. Use bonds to help you make life simpler and more enjoyable. You'd probably stop laughing at the seniors who are invested in bonds when you saw the size of the checks they receive from their bond interest payments every month. The returns are too low, others might argue, but remember, not every investment in your portfolio needs to swing for the fences. Sometimes you need investments to help you solve a problem. Bonds provide stability and income, allowing you to take calculated risks elsewhere, like the emergency fund. Having one is about managing risk. Remember this, bond investing isn't about getting rich quick. It's about building a solid foundation for your financial future. It's about sleeping well at night, knowing that part of your portfolio is working hard to preserve your wealth, rain or shine. So what's your next move? Start small. Maybe buy a Treasury bond, maybe a U.S. government agency bond or a high-grade corporate. You can buy U.S. Treasury bonds directly from the U.S. Treasury on their website, Treasury Direct, with as little as $100. I'll put a link in the description below. Next, learn the ropes, and most importantly, keep educating yourself. Speaking of education, if you found this video helpful, be sure to check out our Bond Basics playlist here on the Bond Guy channel. It's packed with even more tips and tricks to help you become a bond investing pro. Also, I've linked the video I mentioned earlier about some of the strategies like the Treasury Strip one we discussed in this video. Remember, always consult with a qualified financial professional before making investment decisions. Your financial situation is unique, and what worked for one investor might not work for another. Please see the description for the full disclaimer. Thank you so much for watching.